Have you ever wondered why so many investors somehow miss the biggest gains in stock market even when they're paying close attention? Today, we're diving into one of the most fascinating topics in the psychology of investing: why investors miss the best days. Joining us is a behavioral finance specialist and investment psychology expert who studies how human emotions, not just market data, shape our financial decisions. So let me ask you this. Why do so many intelligent investors end up missing the very days that create the most long-term wealth?
It's one of the greatest paradoxes in investing. Most people believe successful investing is about predicting the future. In reality, it's often about managing yourself. Here's the surprising part. The market's best days usually arrive when fear is at its highest. Our brains are wired for survival, not wealth creation. Thousands of years ago, fear kept our ancestors alive. Today, that same instinct convinces investors to run away just before opportunity appears. Imagine checking your portfolio after weeks of relentless market declines. Every headline screams disaster. Friends are selling, social media predicts another crash. Your stomach tightens. Selling feels logical, not because the numbers say so, but because your brain wants certainty. That's loss aversion at work. Psychologically, losing money hurts about twice as much as gaining the same amount feels good. So instead of asking, is this company still valuable, we ask, how do I stop this pain? History keeps repeating this lesson. During the 2008 financial crisis, fear reached extraordinary levels. Many investors sold near the bottom because they believed recovery was years away. Yet some of the market's strongest gains happened shortly after. Those who waited until the news felt positive had already missed a significant part of the rebound. The same pattern appeared in 2020. When COVID-19 shut down economies, panic spread faster than the virus itself. Markets collapsed, headlines predicted prolonged economic devastation, and millions exited their investments. Then, unexpectedly, markets began recovering while the news still sounded frightening. That's because markets don't wait for certainty, they move ahead of emotions. Another powerful bias is recency bias. Our brains assume today's conditions will continue tomorrow. After weeks of falling prices, we expect more declines. After months of rising prices, we expect endless gains. Ironically, those assumptions often appear near turning points. Warren Buffett famously advises people to be fearful when others are greedy and greedy when others are fearful. That sounds simple, but emotionally, it's one of the hardest things anyone can do because it asks us to act against our instincts. The investors who consistently build wealth aren't fearless. They simply understand that emotions make terrible financial advisors. They create long-term plans before emotions arrive, automate investments, diversify wisely, and stay invested through uncertainty. Perhaps the biggest secret is this. Missing just a handful of the market's strongest days over many years can dramatically reduce long-term returns. Those days often occur immediately after the worst ones, making market timing incredibly difficult. So instead of trying to predict every twist and turn, maybe the real investment edge isn't seeing the future, it's refusing to let fear write it for you.
What a powerful perspective. If today's conversation changed the way you think about investing, let us know in the comments. Have you ever made an investment decision based on fear or emotion? We'd love to hear your story. Don't forget to like this episode, subscribe for more insights into the psychology of investing, and share this with someone who needs the reminder that successful investing often starts with mastering the mind, not the market. Until next time, invest wisely and think even more wisely.